So let me go through stocks pretty quickly, and then I'm going to turn to the topic of the day, which is pricing bonds, and particularly risky bonds. So you know that the way we price stocks is using the dividend discount model. If you want to look at a piece of paper as a sequence of cash flows, the cash flows you get from owning a piece of the company is the dividends that eventually they will pay to the shareholder. So the dividend discount model is what's used in the industry, and you just have to come up with various different ways of estimating dividends, particularly for companies that are high-tech companies that don't pay dividends. At some point they will pay dividends, so you can use net cash flow or earnings or other kinds of measures to calculate that. And here's an example going back to Amgen. If we, instead of using that 6.77% growth rate estimate, we start playing around with other estimates and using that dividend discount model, we can get lots of different numbers. Let me give you one quick example. Typically, we estimate growth rates by looking at earnings forecasts, right? But there's another way we can estimate growth rates by saying, look, how much money does the company invest in its own various different projects? Plow back. How much money does it plow back into the company's operations? And of those operations, what is its current return? The return on equity. So if Amgen is plowing back half of its money into its own investments, and if it's earning, let's say, 20% on its own investments, then the growth rate is going to be half of 20% or 10%, right? Because it's plowing back money and it's growing at that rate. Well, if you do that, you know what Amgen's growth rate is? Well, first of all, it turns out that their ROE, their return on equity last year, 26.65%. So they're producing massive returns for their investors. That is a fantastic ROE. What is their plowback ratio? How much do they plow back versus paying out? Their plowback ratio is about 38%. A third of their corporate profits are plowed back. And if you do the calculation, that gives them a growth rate of 16.48%, which is even more ridiculous than a 6.77 growth rate. At 16% growth rate, I can't even calculate what their NPV is because their cost of capital is less than that. And we know that R can't be less than G. So I can actually justify a crazy share price for Amgen, or I can go the other way and use a different cost of capital and a different growth rate estimate and get a number that is actually very close to its market cap. So the idea behind equity valuation is to really sharpen your pencil and actually calculate the growth rates of the various different periods in the life cycle of a company. This is where we want to not use a simple dividend discount formula and assume that dividends change not at all or they grow at the same rate forever, but rather to break up the company's future into different stages: a growth stage, a transition stage, and a mature stage. And so you can use the various different formulas. For the maturity stage, you can use the perpetuity formula. For the transition stage, you can use the annuity formula. For the growth stage, you maybe want to use the annuity formula with growth so that you piece together, bit by bit, what the company is really about. That's the basic approach to equity valuation for these kinds of investments, right? It's conceptually simple, but to do it well really requires a deep understanding of the industry. So when you speak to a finance professor about valuation, you're going to get a very theoretical answer. When you talk to a Wall Street analyst about what's going on at Gilead or Amgen, they know the details of the drug pipeline, what's going on at the FDA, pricing pressures. They will be able to tell you about all of these factors ultimately that impinge on R, G, D, and even T, the time horizon over which these kinds of considerations take place. All right, that's it. That's about all I'm going to cover with equities. We're going to take various different aspects of this idea and apply that over time to looking at valuations in the biopharma industry